All right. We'd like to welcome everybody to our November 2024 market update. I am Brad Engle, the Director of Research, Trading, and Portfolio Analytics here at GHP Investment Advisors. With me, as usual, is Christian Lewton, our Chief Investment Analyst. We'll jump to the disclosure page. A little background on us for those of you that are not familiar. We are a Denver-based registered investment advisor. GHPIA is a fiduciary. We have around 2.8 billion in assets under management, and we're right around 30 employees. Little news or headlines for us. We recently found out we were named to the Forbes top RIA firms of 2024. We came in at number 103. They take the top 250 out of over 25,000 companies that are invited for consideration. So I've been with the firm 13 years. I'm very proud of this. This is a great list to make. So I just like telling everybody and touting it. As we just found out, we just put out some social media on it. So please tell everybody you know, because I'm very, very excited about it. But let's get to the agenda. To start, let's go with housekeeping. If you have a question, at the bottom of the page, there is a Q&A button. Click on that, type your question in. It will show up in a queue that Sophie over here is managing. We're going to try and pool questions together that are similar. We did have some registered attendees send questions in advance, so we have those in there as well, and we've been pooling them together. But as of today, for the agenda, we're going to talk about the labor market and the consumers. We will talk about the investment environment, and we will talk about the election outcome. And we do have quite a few of the questions that came in were from the election, so we will address those at the end as well if we don't touch on them during the presentation. So Christian, let's go ahead and jump into it. So looking at this first chart, these are some key economic data points that we look at when kind of evaluating the economy. There are many we look at. These are just some of the more important ones that we track. Looking from left to right, you can see real GDP is above average since 2020. So the gold bar is the latest reading, where the gray bar is the average since 2020. And obviously during that time frame, we went through a few market disruptions, being the global financial crisis and COVID, things of that nature. But you can see real GDP, which is all products and services produced in the US for a certain period of time, is above historical average currently. Real disposable income, which helps drive that. If people have more money to spend, it helps drive GDP, above average since 2020. Our unemployment rate is below average during that same time frame, which is good. CPI, which is inflation, is trending slightly below where it has been since 2020 on average. Christian will get in, and some of these data points we will get into in deeper conversation later in the presentation. Now, wages, same thing, increased their latest number above average since 2020. These are all good numbers, showing that, COVID had disruption. There was a lot of economic data, but we are, trending above average. So that's a good sign to us. Christian, if you jump to one of the data points. So looking at this is a 3-month rolling average U.S. non-farm payroll. What this is just jobs added to the U.S. economy. And this number, we talk about it whenever it's released. And you can see, if you look at the very right where Christian's pointing, kind of where we are today, we are back near the average line since the 1970s. Now, since the 1970s, on average, we have added about 134,000 jobs monthly. With that being said, the last reading that we just had actually came in light at about 12,000 jobs added. That didn't scare us because there was a lot of, disruptions within that number. That 12,000 jobs added came with 2 hurricanes that went through Florida, Milton and Helen. And also Boeing had a very large strike that just got resolved the week before last, which manipulated that number a little bit. Christian and I did some calculations, and we think the number, if you normalize it, it would be closer to 130,000 jobs added. So the headline, stated we only added 12,000 jobs. Are we slowing down? We think the disruptions changed that number slightly, and to normalize, we got to about 130,000 jobs. Now, what you can see, if you look a little to the left, you could see the very large dip and the very large increase in the line. That was obviously COVID. We had disruption. There was massive job loss. Then the people came back into the workforce in large numbers, which then after that, you can see that there was a lot of volatility and kind of trying to figure out where the job market's going to go. But what's comforting to us is that we are back near historical trends. And if you look further left on the chart, you can see the gray bars. Those are recession bars. So you can see that during times of recession, historically since the 1970s, there's typically job loss during these times. We're still above that. We're still trending towards average. So we are happy with the jobs that have been added. And so we're going to continue to hopefully stick around that average line.
Yeah, thank you, Brad. And so I think, as Brad just explained, I think the key is we are finally seeing a much more balanced labor market again. And this has really helped take the pressure off of wages and also been a big reason why we've started to see lower inflation in the US economy. So I think you can really see this story play out if we look at the chart on the left here, which shows the year-on-year percentage change in both wages and inflation. So if we focus on the gold line here, which is average hourly earnings, you can see that during the pandemic, the wage growth was very erratic. You can see it spiked to 8% in April of 2020, and then it dropped to just 0.5% in April of 2021. However, since early 2022, as you can see here, wage growth peaked again. We've started to see the signs of this much more balanced labor market. And this is really just due to more people returning to the workforce after COVID. And as a result here, you can see that wages have gradually been returning to more sustainable levels. And I think what's really important about this chart and why we wanted to focus on it today is that while wage growth, again, is continuing to normalize, it has actually been outpacing for inflation for 18 months now. You can kind of see the crossover here. And this is really a key point because that means that real incomes for consumers have been rising. And if we combine that with the remaining savings surplus from the pandemic, this boost we've seen in real income has played a big role in helping the US economy continue to grow over recent quarters. As Brad's first chart pointed out, this was the 3Q. The latest print was third quarter 2024 real GDP growth, which is 2.8%. I think we can further make this point if we look at the chart on the right here, which shows real disposable personal income, or really just the amount of money an individual has left after taxes. So the blue line is actual disposable income. And you can see after a very turbulent here few years through COVID, it is now pretty much back in line with pre-pandemic trends, which you can see here by the gray dotted line. So with income stabilizing, consumers are finally feeling more secure and regaining their financial footing. And this has really helped fuel strong spending growth. And when we kind of relay this in terms to the market, this growth in spending also continues to help drive corporate earnings. If we use the S&P 500 as a benchmark, we are now on track for 5 consecutive quarters of year-on-year earnings growth. And if we look at full year calendar year 2024, earnings are expected to grow over 9%.
Yeah, and to further show strength of the consumer, it's important, we talked about at the very beginning, the labor market remains solid, real wage growth is positive, household balance sheets are healthy. But to further show strength of the consumer, look at this chart on the left, total debt balance by delinquency status. So you can see the bars represent, 30, 60, 90 plus days of delinquency. And headlines have said, recently there's been an uptick in delinquencies. And we talked about this extensively in our last market update, if you recall, if you're on, if not, you can get it on our website. But headline numbers had ticked up for delinquency. We said, we were not as concerned, and you can see here even though we have seen this recent tick up, we are still below historical averages back to 2003 and still below where we were pre-global financial crisis, which is this large spike you see kind of in the middle of the page. Now, if you go to 2020, you can see kind of when the stimulus kicked in during COVID. Obviously, the government implemented stimulus to the masses, and people used that money to pay down or at least catch up on delinquencies. And that continued to trend down until recently, where it started to tick back up. But with that being said, the consumer is still showing a lot of strength from a delinquency standpoint. And to further kind of the strength of the consumer, the US household leverage chart on the right. So when you look at this chart, think to yourself liabilities or debt over assets or wealth, if you will. And so the higher the number, the shows that there is more leverage or debt to the assets that somebody owns or a household has. And you could see that during the global financial crisis in 2008, the spike in this number makes sense, right? The value of people's homes fell, the stock market was down, and there was a lot of pressure. Well, you can see that even since the global financial crisis, we have been trending in the right direction at bringing this household leverage number down, meaning that asset values have grown, which makes sense. Housing values are up. The stock market, even since the '08 crisis, has been on the right track. Given there are hiccups along the way, which we can see right around 2024, where the line kind of bumps up right there where Christian's pointing with the pointer. That was when the market was down in 2022. Some people might not even recall that the market was down in 2022. But I think the driving point here is that now, given Christian talked about inflation, and we do understand that we're all feeling inflation, and some of that inflation is more sticky than others, and prices, have not come back down. Overall, U.S. households are on better footing and consumers are in a better position. But that is, despite the rising borrowing rates that we're seeing, that Christian will touch on.
Yeah, this is just another area where we are starting to see some normalization, is the interest rate environment. So focusing today in the chart is the U.S. Treasury yields. So we can see that after the global financial crisis, the Fed stepped in with many quantitative easing measures. It's really just a fancy word to say that they kept interest rate low and they're buying up Treasury bonds in order to boost the economy. This here, as you can see, kept yields very low for a very extended period of time. If we look at the blue line here, this is the 2-year Treasury yield. So this averaged less than 1% from 2008 through 2017. The green line here is the 10-year Treasury, and this averaged less than 2.5% over that time. So naturally, this led to a very prolonged period of low returns for fixed income investors. However, if we look to where we're at today, of course, after another dip here and another round of quantitative easing from the Fed, we're seeing a much more normalized yield environment with treasury yields more in line with their longer term averages. This is definitely a positive for investors as they finally can actually earn a return on their cash. We still view this as normalization in yields and not a reason to necessarily get overly excited, meaning we're not jumping to buy longer term bonds or extend duration, and we're not rebalancing client portfolios to overweight fixed income. Instead, we're actually maintaining our approach and focusing on short to intermediate term fixed income securities in client portfolios. And we're also staying committed to equities in this normalized rate environment, which brings us to our next chart here on the left. So this chart shows equity performance, and more specifically, growth stocks versus value stocks in certain interest rate environments. So if we look at the far right side of the chart here, you can see that when the 10-year Treasury rate is above 5%, which I will point out, you can see it down here, has been 50% of the time since 1979. Both growth and value stocks saw average annualized returns above 15%. If we kind of flip our attention and look at the left side of the chart here, we can see that these two bars, So when the 10-year Treasury rate was below 3%, which, as I just described, has been most of the past decade, you will see that growth stocks dramatically outperform value. And this honestly, this trend makes sense given that lower rates, they reduce funding costs for growth initiatives for companies, and they actually also tend to fuel more speculation in the market. If we look at where we sit today with the 10-year treasury as of this morning around 4.42%, we kind of sit in this 4 to 5% band. And as you can see, value stocks have actually slightly outperformed growth with average annualized returns just over 10.5%. So we're not showing this chart today to make a call that we believe that value will outperform growth or vice versa. However, we are showing it to say that equities in general have historically performed well in these more normalized rate environments. And if you actually think about it, this relationship is very logical given that higher rates usually are reflective of a stronger growing economy, which can and tend to lead to higher earnings growth for companies. Overall, our approach, we still believe that best approach is to be diversified. So that is allocating to both growth and value stocks, as well as different size companies and as well as different sectors. And I think this is especially true in today's environment when we look at some of these mega cap tech company valuations.
Yeah, and just like our last webinar, for those of you that tuned in, we extensively got into the Magnificent Seven and the names and valuations in there. But we are still seeing elevated valuations in large cap growth space, as you can see on the chart on the right, the very left blue bar. And although we are still seeing these, we are still investing in this asset class. However, we're closely monitoring many of these companies. And as Christian mentioned, when we think about diversification, we invest across all these asset classes. And when you look at the valuations, they are more in line with historical averages. So it all kind of makes sense. But Christian, let's move on to the so we're going to get into the kind of political portion of our slides here. So I just want to emphasize for investors, it is important to remember that the outcome itself is no reason to react emotionally. We think that that is how investing mistakes are made, okay? We are not making any adjustments to our client portfolios based on the election. We are sticking with our typical balanced, long-term, and diversified portfolio management. And I think that these charts highlight that it's not about, it's kind of that the old adage, it's not timing of the market, it's time in the market. And that's where what we feel is very important. So if you look at this chart on the left, time in the market matters, not the president's political party. So this looks at $1,000 invested in the S&P 500 in 1953. Now, if that $1,000 was invested only when a Republican president was in office, it would have grown to $30,782. Now, these numbers are as of 9/30, 2024, I believe. Christian, you can correct me if I'm wrong. If you only invested when a Democratic president was in office, that $1,000 would have grown to $69,629. Now, if you were to stay invested across all, $1,000 would have grown to $2,143,000 and some change. That is a dramatic difference. So again, the idea is not to react emotionally, because that is how mistakes are made. And we are going to continue to hold strong on our investment philosophy. We feel that our risk adjusted or our risk analytics and our benchmarks and things of that nature will still hold strong through this. So now if you look at the chart on the right, the average annualized S&P 500 performance from 1950 to 2023, this gives a good representation that whoever's in office, regardless, the market on average, you can see here, the annualized returns increase. So if you look at the left side of the chart, the Democratic president, if you had a Democratic president and you had Congress was blue, so the House and the Senate were all blue, on average, since historically 8.72%. The middle line is the divided if the House or Senate were blue or red, and then on the right it's all red. Well, if you go to the very right of the chart, this is where we sit today, and I saw that as of yesterday, the House has got the votes to be majority Republican. So this is where we sit today. Republican president, and Congress has gone red. Again, it's not timing in the market, it's time in the market. And we feel that corporate earnings help drive the market, which is where we're going to continue to sit and keep front of mind when going through this. But a concern right now is the US debt, which Christian will touch on.
Yeah, and I know we've harped on this quite a bit. I think we had our May economic forum on this as well. And I think it's interesting because we've talked a lot today about normalization that we're seeing. However, we're kind of shifting here to things that are not normal, which is really the current level of federal debt, which, as you can see at the chart on the left here, is just shy of 100% of GDP. So if we look at the actual chart, you can really see that the global financial crisis, as well as the pandemic, have been the primary contributors to this higher debt load. However, what's really concerning right now, and particularly concerning, is the current fiscal policy, and it seems like the incoming fiscal policy are going to continue to run these deficits that are around 6% of GDP, which we can see in the chart on the right here. So why does this really matter? Well, as I just showed you, interest rates have been normalizing, which is really creating this new layer of risk for the government, as they're going to have to refinance the existing debt and also issue new debt, being that we are running a primary deficit at these higher rates. So this means the cost of servicing the debt, or really just the interest that we are paying, will only continue to increase, putting more and more pressure on the deficit and the overall debt load. And just to be clear, as I don't want to scare anybody too much today, the current level of debt relative to the size of our economy right now at this moment is still manageable. However, the path that we are on, if we continue running these very large fiscal deficits, is unsustainable. We ultimately believe that Congress, if Congress doesn't step up, or at the very least just come up with a real plan to tackle this deficit problem, the bond market will eventually force them into action.
Yeah, and I think we went into this extensively at our economic forum in May. And if anybody wants to take a look at that, it's on our website, GHPIA.com, under resources. But we got heavily into this one during that time frame. But we'll go ahead. I know a lot of questions have come in and on specific things which we were expecting, and even the ones we got in advance. But if anybody has questions that don't get answered within this webinar, please, this is Christian and my contact information. Reach out. We love having the phone calls. Send an email. We'll get back to you. But if you know anybody that wants to have a conversation about any of this, let us know. We're always happy. This is the fun part of our job. We get to enjoy this. But let me jump to some questions, because I have a feeling that we're gonna be answering questions for a little bit here. So Christian, let's start with we've pulled quite a few together about tariffs and immigration, and I think policy revolves around that. I think it's a big question that people want answered. So would you like to?
Yeah, I'll just like to summarize. I believe the question was, how will deportation and tariffs impact inflation and the economy?
Yeah.
So starting with the tariffs. So in regard to the impact on overall the financial markets, I think for now it does seem like we are in more of a holding pattern. However, as we move closer to 2025, we would expect volatility to pick up, much like we saw in 2018 with the tariff wars. And this is especially true as the market really tries to digest what could or would be implemented. I think when looking at the actual new proposals from the Trump administration, it does seem that this round could be different from 2018. And this is strictly just given the size and the scale that's being floated around. If we look back to 2018, we saw the total goods that were actually impacted by tariffs. They were valued around $300 billion. Right now, current proposals have a 60 to 100% tariff on all Chinese goods, which I just went back and looked at the 2023 imports from China, which totaled $450 billion. And then we've also heard this 10 to 20% broad-based tariff from other countries or on other countries, which could impact another 2.5 trillion in goods. So again, when we start comparing to 2018, we're really talking 10 times the amount of goods potentially impacted. So I think if these are implemented, it's really hard to imagine a scenario where we would not see inflation reaccelerate. And this is really just simply due to the fact that US importers, who are the ones actually paying the tariff, would be trying to pass these increased costs on to US consumers. And then kind of thinking more globally in the global ramifications, it's really also hard to imagine that we wouldn't see retaliation from other countries. And I think this back and forth, this would really push prices up for consumers in other countries as well. So I think when we think about the global economy, it's higher inflation, which could reduce spending on other goods and services, which may ultimately slow down global economic growth. I think the good news from what we understand is that the executive branch can only impose some of these tariffs if they are related to national security. So in other words, Congress would need to approve some of these more broad-based tariffs, which, as Brad pointed out, even with a red sweep, could definitely be a hurdle. I think that's true, especially when we start looking at the vast number of industries that could be impacted. Shifting to the deportations, I think this relates a lot about what we talked about early in the presentation. So we mentioned that currently we are seeing this much more balanced labor market with labor force participation going back up and prime age at all-time highs. However, if we were to see workers forced to leave the labor force, it's likely that we would see wages, and I would say particularly in certain industries like construction comes to mind, reaccelerate. So I also think this would be inflationary as well.
Yeah. Yeah, and I agree. I think both of those situations are inflationary. But this is a fluid situation. We monitor just like any last election, things of that nature. Things change, and as we've seen in the past across years and years and years, people get elected because of policy, and not all policy gets through. And there could be a point of negotiation and things of that nature. But again, this is a very fluid situation, and we continually monitor. And some of the questions coming in are, what will change with our investments, or will they stay the same? As of now, we're sticking to our long-term, fairly valued philosophy. And for clients that are changing, maybe nearing retirement, things of that nature, there could be a potential shift to more fixing some things of that nature. But we feel comfortable with where we are right now with our risk matrix, and we look at many different factors in our investments, and we evaluate all asset classes from real estate to fixed income to large, mid, small equities to foreign. Nothing's going to change in our eyes right now. We're going to kind of stick to our investment philosophy. There was a question about international and emerging markets. Christian, do you feel like tackling, or you want me to grab it?
Which one?
It says, regarding tariffs, what would you expect the effect to be on international and emerging market stocks?
I mean, I think I kind of hit on that. It's a fluid situation. It's kind of hard to tell, but based on some of these numbers that have been floated out, it's likely we would see retaliation. Again, the whole picture here is like if these do get implemented and you start seeing retaliation from other countries, likely you would see inflation in those countries as well, which again, the whole is slowing economic growth. So I think that's the same kind of what we're saying on the US side as far as international and emerging markets.
Yeah. There's a question that says, what did Christian mean about what would happen if Congress does not tackle inflation? I don't think you meant to say inflation in that. Were you talking about the debt?
Yes. So I think
Yeah,
if Congress does not tackle the deficit.
the deficit, not inflation. Yeah. Clarify
yeah.
that.
So what we mean by that is really that we believe if the bond market will force Congress's hand, meaning that you would start the so-called bond vigilantes may start coming out and selling off treasury bonds, which would push yields even higher, making it much harder for basically the lack of buyers, making it harder for the government to actually issue more debt. So essentially forcing them that they cannot continue to run these large deficits.
Yeah. Sorry, I'm trying to.
I mean,
I
here's
read an article. I read this article as well. Somebody asked the question about Goldman Sachs
yeah.
recently predicted only 3% S&P 500 growth over the next 10 years. How do you feel? And can you reconcile to your projection? That was real. I believe it was real growth, right? They were talking about non-inflationary, or was it S&P? I thought they said it was GDP. When I read the article, I believe Goldman came out and said 3% GDP growth over the next 10 years.
I think it was the S&P. I think it was
Was it the
they're
S&P?
predicting the average annualized return for the S&P around 3%.
Around
And I
3%.
did read that too. I'm trying to remember the exact, because that was from some Goldman Sachs economist. I believe a lot was due to valuation, which again, we harp on all the time as far
Yeah.
as when we look at Brad showed the large cap growth asset class, and you can see the valuations trading well above historical averages. And
Yep.
when we look at the S&P 500, this has turned into more of a large cap growth type index. And
Yeah.
if you given the concentration we see, is it 39%, I believe, is the Mag 7 or top 10 companies today. So I think
35%. Yeah. They said around 35%.
so I think a lot of that, the basis on the only 3% was really just looking at the valuation of some of these companies that really dominate the index.
Mhm.
I know if you just go pull just a simple average and look at the top 10 stocks, the average is close to 50. Now, that's being pulled up by Tesla, which I believe as of today trades over, I think it's 110 times forward earnings. So, but still, you're seeing froth in that area of the market. And I believe that's kind of the consensus from the Goldman Sachs analysts that we are starting to see this concentration and these high multiples in this large cap growth space.
Sure. And to Christian's point, I think, if 7 stocks make up 35% of the S&P 500 and are driving up that valuation, there are 493 stocks below that some, by industry and sector are reasonably valued, and we continue to look at those. And to Christian's growth to value during higher rate environments, it doesn't mean we're going to go straight to value or growth. We will keep our allocation, but we will always continue to look for fairly valued securities that fit within our benchmarks and kind of our criteria. We just would prefer to stay away from the high flyers. Like we said in our last webinar, NVIDIA's growth is amazing, absolutely amazing. When you're growing revenues by 150% and profits by what, 90%, Christian? But our theory has always been, that's great, but what happens when NVIDIA only grows profit by 90%? Or excuse me, revenues by 90% instead of 130. 90% is still amazing. That is an amazing number. Most companies will never say that they've ever been able to do that. But the market will not like it. I mean, we just saw Microsoft, what was it, 2 weeks ago, reported. They came in with their estimates in line, and they fell 6% that day, just because the market has become so influenced by the NVIDIAs to where they expect these large leaps in revenue and profit. And when they don't happen, people start to figure out how to realign. So again, we don't believe that they're bad companies. They're amazing companies. They're just way too expensive for our thinking currently. Christian, I see one on bond markets. You kind of we talked.
Yeah, it's here. Yeah. What is the current outlook for bond
Yeah,
markets, short, medium, long term?
yeah,
So first of all, I would say we are not in the business of trying to predict the yield curve. We talked today that we actually believe today's environment, obviously the short end is still a little higher than you would typically see. I've looked at this data in the past. We believe the 10-year treasury hovering around 4% very much makes sense when you think about where the inflation target is, where inflation's at today, and then the real GDP growth that we are seeing, which is around 2%. So 4% for a 10-year treasury, that's kind of our threshold and what really does make sense to us. The short end, I would say, is definitely higher. Obviously, we're trying to combat inflation today, but we actually think we're very much in a more normalized yield environment, especially when we compare back, 5, 6, 7, 8 years ago.
Yeah, and the Fed continues to cut. I mean, the Fed's last, what they did, 25 basis points, was not last week, was it the week before? No, it was last week on Thursday.
Yeah.
They did a 25 basis point cut, still trying to combat inflation, but Christian and I also think that they have a dual mandate of stable prices and stable jobs, basically. And so they don't want to overshoot. So, slow cuts are what makes sense, even though inflation, it is, coming down and it's nearing their mandate. But that helps drive up higher Fed rates help drive up the short end of the curve. And to Christian's point, that end of the curve makes sense to come back down as they continue to cut the Fed rate, where the rest of the curve kind of sits at, we're starting to get back to normalized levels where we think, bond rates should be at certain points along that line. So when it comes to short, medium, long, obviously right now we've continued to stay short duration. We've extended out to what, 5 years? And so we continue to try to ladder bonds for those in fixed income, every 6 months, from 6 months to 5 years, so that when they roll off, we're potentially, investing in a higher rate environment at certain points, but we're not really going out past that on our allocation. We still like the short end of the curve right now. I saw one coming on crypto, and I think we had one earlier. Let me see. Any interest currently in crypto? No.
I knew we would get one of these questions.
I'm not saying it in a bad way. I think that I wrote a piece a while back about Bitcoin, or crypto in general, and I stick to my guns about it. We do not feel that there is any intrinsic value in cryptocurrencies. It is definitely a speculative asset class, and I will still hold to my guns to say that. It is, there's no cash flow behind it. There's no revenues behind it. I can't do a discounted cash flow model to back into the value of what it should be. In my eyes, or I guess in our eyes, it's strictly speculative. And the fact that it's run up to where it has, because that was the second part, rocketed since the election. I think the incoming administration has talked about, and Christian, you might know more detail, but they've talked about establishing a depository or something, a federal depository for Bitcoin or cryptocurrencies, because they want to use it as an alternative currency, things of that nature. Again, it goes back to our talk about tariffs and other things in fluid. It's a fluid situation. Is it really going to happen? I don't know, but we still don't see value in the speculative, crypto space. You have anything to add?
I think the whole thing, why it's gone up since the election, I think that maybe better regulation around it, less regulation maybe around it. I think that's a key topic. I think just in general, when we look at crypto, if you run the correlation between Bitcoin and the NASDAQ 100, they're very positively correlated, which makes sense. And if we look at the overall market this year, the market's been doing well. So it makes sense that you kind of see this speculation on Bitcoin higher. But I mean, it is the ultimate speculation vehicle.
Okay. Okay, good question. This is, Sophie sent the last one. I think we got time for one more. Last question. It says, with the previous jobs report data, do you feel the Fed will continue to cut rates as planned or pause at the next meeting, and why? You want to go?
I can hit this one.
Yeah, go ahead.
So for one, the Fed continues to mention that they are going to be data dependent. And we just had a CPI report yesterday, but we have another CPI report that comes out before they make a decision. And we also have another labor report that comes out, which will be early December sometime. Yeah. So I do think that they are paying closer attention today to the labor market. So to your question, like looking at the last 12,000, they've kind of mentioned that they do not want the labor market to deteriorate any further. So, and then when we look at the CPI yesterday, again, we've kind of continued to say that we do still see a positive trend with inflation trending back to that 2%. Kind of getting into nitty gritty of the data yesterday, I think shelter costs are still the very sticky piece of that. More specifically, when we look at core CPI, it makes up 43% of the core CPI index, and shelter alone contributed 62%, I believe, of the 3.3% year-over-year increase in core CPI. So I think at this point they are very clear that they do not want to see further deterioration in the labor market. So if we were to get a lighter labor report than what we're expecting, I would expect another cut.
Yeah. Yeah. And we're not expecting large jumps in cuts. It could be 25, 50 basis points, but they don't want to overshoot. They don't want to undershoot. They're trying for that soft landing. And I think Christian and I touted that on our last webinar, that we expected a soft landing. We thought that we were already there, which later I think JP Morgan or Goldman Sachs came out and said they said it's a soft landing, and we like to say that we said it before them, but obviously our voices aren't heard as far. But yeah, it is, again, it depends. It depends on the data, and I think as it comes in, they evaluate. I'll address a couple of things. Somebody did comment that I said in the first chart 2020, not 2000. I apologize. It was all the way back to 2000, not 2020. That data, that historical data, those averages were all the way back to 2000. But I think we're kind of right at time. I don't want to drag or keep people on. Again, if you have questions we didn't answer, or if you want more clarification, our contact information is still up it's on our website. It's on the page right now, but please reach out. We enjoy having conversations, and hope everybody has a great rest of the day.